Ready to get this party started, Steve?
Okay, it's showtime. Welcome to the June 2020 Economic Update. I'm Steve Rosansky, President and CEO of the Newport Beach Chamber of Commerce. This is the fourth in a series of economic forecast updates that we began starting back in March. A lot has changed since our last update less than 4 weeks ago. The NASDAQ is up 1,000 points to a record close yesterday. The S&P 500 is up 400 points, a 13% gain. Dow Jones Industrial Average is up a whopping 4,000 points for a 17% gain. And West Texas Intermediate Crude Oil is up $10 a barrel from $27 to $37. On top of that, we've seen an unexpected drop in the unemployment rate from 14.7% to 13.3%, which I think Chris will be discussing a little bit later in the program. I want to thank the various chambers of commerce that have joined with us to promote today's event. With their help, we have over 1,100 registrants for this forecast webinar. And of course, none of this would be possible without the help of the UC Irvine, the Paul Merage School of Business, and the Center for Investment and Wealth Management. Now, if I can quickly describe our program and introduce our speakers who will break down what's happening in today's economy. First, you'll hear from Chris Schwarz, Associate Professor of Finance at UCI and the Faculty Director for the Center of Investment and Wealth Management. Chris has been our featured speaker at the last 3 updates. He's going to cover the economy and the financial markets. We also have a special guest speaker today, Bill McBride, the creator of the well-respected Calculated Risk blog. Bill will be discussing the current state of the real estate market. After Chris and Bill's presentations are completed, they'll be answering some questions. If you do have a question, and this is very important, please type it into the Q&A box, not the chat box. We will not be monitoring the chat box for questions. And so with that, I will be turning over the presentation to Chris. Take it away.
All right, thank you, Steve, and thank everyone for joining us here today. Really excited to, of course, be here and give you guys another update. And a special thank you before I get started here to Bill McBride. So Bill is he's my blog hero. So he's Calculated Risk blog is the only blog I read every day, and so I'm grateful that Bill can join us today and be part of this webinar. So before I get started, I'd also like to personally thank the chambers. As Steve mentioned, I speak at the Newport Chamber and of course the Greater Irvine Chamber events. And knock on wood, we'll still be able to have those events in person this year. And as of course the Newport one would be in October and Irvine would be in January. And I know we have a number of other chambers, too many to mention by name here, who are joining us here today as partners, and we appreciate all of your support. So of course, I'd be remiss if I didn't give a little bit of a 45-second plug here for what we do at the Paul Merage School of Business. So one thing I just want to do is I want to plug our students. I know, of course, we're talking about employment coming up here, but we just have an incredible set of students here at the Paul Merage School of Business, and I thought I'd just throw a few logos on some of the places we've recently placed students. And if you're a former student who's been placed somewhere and you don't see the logo, that doesn't mean we're not proud of you. Of course, we love all of our children equally. But just to give you an idea out there, community, if you are looking for interns or if you are looking to hire, make sure that you're looking at our students when you do. I'll put our students up against any students from any school. So I have the email address there for career services if you want to take a moment and in the future email them. And the other thing, of course, I want to do is, as Steve plugged, this is part of the financial literacy mission of the Center for Investment and Wealth Management. We've been incredibly lucky this year to be able to promote financial literacy and educate over 10,000 participants here in the community through all of our various programming at the high school, college, and community level. And so, really couldn't be more proud. We don't receive any funding from the school, the state, or the university. And all of this is simply made possible due to all of the board members of the center and our friends. And really the program that, just want to highlight quickly here, we're going to talk about employment a little bit. And of course, the biggest financial literacy lesson that you can ever teach a kid is to get an education. And we have a program called LifeVest that's, we got some help from Pacific Life in sponsoring. And so we thank them for that sponsorship. And of course, this is the time of year when you find out where kids are going to college, and we're incredibly proud. These are just a few examples of the students that we've had through the program. And you can see we have 2 going to UCLA, one my neck of the woods, Penn State. My grandma would be so proud. She's a big Nittany Lions fan. A couple to UC Merced and Cal State Fullerton. Of course, here we have one student that we know is going to UCI. So this is just a sampling We've had 87% of participants in the program go to college, which is almost 3 times the baseline. And so we're really proud of the work we do through the center. And so again, I thank all the board members and all the staff here at the center that makes these things possible. And so just before I get started, if you want to help us out, help more students get an education, you want to help more people learn financial literacy, there's a little QR code there you can scan here to give us a few bucks if you learned something good today. A nice, easy link that you can remember. And of course, if you firm or you'd be interested in getting more involved in what we do, you can check out our website at mirage.uci.edu/CIWM. And just in case you get more inspired to give as we go along here, you can see in the bottom right, I've left the URL for giving. All right, so enough about kind of that's my 45-second plug. All right, so right now we kind of feel like this in the economy, right? So opening the door, looking outside, and we're getting punched in the face, realizing that things aren't back to normal yet. So a great scene here from Die Hard 2. And so part of that is, when you look at the employment report, you can see here that we have, last month we had 2.5 million jobs created, which looks great, except when you put this in context, of course, of losing about 20 million jobs last month. And again, I think it's always important with these numbers to keep things in perspective, because you could spin it and say, well, we had record job growth last month. But of course, the downside is way more than the upside. And if you look at unemployment, you can see our unemployment rate actually went down to 13.3%. And so these data came out last Friday. And I'll just note here, this is way above even the prior recession, which was the worst recession since the Great Depression. And you see these data, and I think really kind of the response of most people who saw the job report last week was kind of like, what? Wait a minute. How did this possibly happen? How do we gain jobs? And of course, if you look at economists' forecasts, economists were predicting 8 million jobs. And so, of course, after the fact, they'll tell you that, oh, don't worry about it. It's science. So don't worry. We had this thing under control the entire time. We knew exactly what we were doing. And really, I think the confusion came from the Sesame Street game that I used to play. And so I know I'm dating myself a little bit because, kids watch SpongeBob and other things these days. But when I watched Sesame Street, we had this game we used to play called Which One of These Does Not Look Like the Other? You can see the one bowl here is bigger than the other 3. And the reason that this was such a surprising number is because all the other data really said, well, I mean, we're fine. We're going to have job losses, not as big as the first month, but certainly we'd expect job losses. And so I have 3 sets of data here. So the blue bar here is total new claims. So if you add up all the new jobless claims over the prior 4 weeks, that's in blue. Then I have in orange here, which is the increase in continuing claims. So these are people who are on unemployment week after week after week, and that's in orange. And then you can see the gray bar here is the number of jobs based on the payroll data, which is the data we got on Friday. And you can see that, of course, the first 2 months match up perfectly, and then the last month looks a little bit strange. And so a lot of people have been trying to figure out why the payroll data looks so much different than the other 2 sources. And so that's really been kind of the question. There seems to be this idea that there's some kind of data issue. So people have been talking a lot about this misclassification of jobs. What's a temporary job or a furlough job? Is it unemployed or not? And really, if you look, they had the same issue in April. So that's really not the explanation of what's going on. The other thing you'll notice, the jobs report's actually taken in the middle of month. So this is like middle of May data. This isn't end of May data. And so this is before the reopening. And so really, it seems like the most plausible explanation of what we're seeing is something to do with the PPP program. All right, so this is the Payroll Protection Program. So if you're not familiar with it, it's a program for small businesses where they could apply for a loan that under circumstances would turn into a grant or essentially free money if you want to think about it like that. And so far, the program's given about 4.4 million loans of $510 billion. That was the data as of this morning. And the loan started in mid-April, late April, I think is probably when a lot of people first got their money. And the rule was you could get up to about 10 weeks of payroll. So I'm being a little loosey-goosey here. So if you know the exact rules, it's not exactly that, but that's essentially what it is. And if you want to get forgiveness, i.e. if you want to get turn this loan into a grant where you didn't have to pay it back, you had to use 75% of your money on payroll within 8 weeks. All right. And of course, if it's about 10 weeks of payroll you're getting and you're using 75%, 8 weeks, you essentially had people on the payroll the whole time to get it to turn into a grant. But the issue is probably some businesses were laying people off, of course, hoping the closures would happen quickly in terms of reopening, and then they didn't. And then, of course, they realized that, hey, I'd rather have 25% free money than no free money. And so they started to hire back employees. Now, an interesting question, of course, is the program's been modified a couple of days ago, actually June 3rd, where they changed it so you only have to spend 60% of your money now on payroll instead of 75%. you now have 24 weeks to pay it back under most circumstances instead of 8. And even now, the administration is talking about even easing the rules further, where it's not a hard cutoff to get forgiveness. If you're a little short of 60%, you'll still get most of it forgiven. And of course, now you're thinking, well, of course, if you have more time to pay these back, and we look at the data coming up, it might lead to some more layoffs coming up the next few periods, right? So that's going to be something to look at when it comes to unemployment. All right, so we go ahead. It's important to keep things in perspective here for employment. So I have a lot of data on this graph, and so I think there's 3 things I just want to highlight. So number one is, regardless of what happened last month, we're down 16.1 million jobs since February. Just a huge number of jobs when you really think about it. It's about 10% of the workforce that's been laid off. So that's the first thing I want to note. The second thing I want to note really is this recession is going to have a huge impact on wealth and income inequality. All right, so when you look at the jobs that are lost, you can see those in the lowest education category, those that are already making the least amount of money, are the ones that have had the most percentage of layoffs, right? And so again, this is affecting those people that were already making less money more than they're affecting those people that made more money, right? So and the discrepancy is almost 3 times more impact on those that had less than a high school degree, making the lowest amount of income. And again, the third thing I just want to point out related to the financial literacy mission, and the most important thing we could teach kids is about education, is, we as a society should really be pushing education, because if somehow we could turn those bottom 3 sets of educations, we could get all those people to go to college and increase their participation rate. We look at the participation rate, it's double for college students that is for less than high school, right? So if you have less than a high school degree, there's only a 1 in 3 chance you participate in the economy, and you'll make 1/2 the money. And so the difference is a huge amount of money. And you can see there that we'd be able to get $4 trillion more of income per year if we could get more kids to go to college, or all those kids to go to college. And of course, that means that there's more spending. So if you run a business, that's good for you. If you have an investment firm, that's more money that people can invest. And even if you're a diehard, well, what's good for everybody if I don't have kids? That's about $800 billion in tax revenue that we get per year. So it benefits everybody if we can get people to get an education. All right. So really, when it comes to May economic data, we had the jobs report here, but we have some other data. Now, this is kind of how I feel like, this is from Major League, right? Where people look at the data and they're like, yeah, it could be worse. It's not, well, not too, this data could be, a lot worse than it is, right? And of course, then you really look at the data and you realize, well, it's still crappy, right? The data is still bad no matter how you look at it. So this is the Empire Manufacturing State Index, and you can see, things are a little bit improved. But really, they're still lower than they were back in the big recession that we had. If you look at the manufacturing index, it's a little bit better than it was back in the Great Recession, and it had a little bit of a bounce. The one thing I'll note is, a lot of these indices are kind of probably understating the problem. So if you look at new orders, you can see it's closer to what we had in the last recession in terms of the drop. If you look at, service, this is non-manufacturing. Again, you can see it's improved a little bit. But again, if you look at things like the employment part of this report, you can see that things really didn't improve much, and they're as bad or worse than the last recession. So the bottom line here is we have a bunch of data, and no matter how you look at it, it's not great data, right? So it might be better than April, but of course, April had a pretty low bar in terms of what we set. And if you look at light sales, it's ditto, right? So I could sit here and go through a bunch of data. All right. But it's just like, eventually here on The Bachelor, if you watch The Bachelor enough, we get it. Okay, we can move on here. All right. So let's look at some other high frequency data. So we've been relying on some high frequency data. And, I mean this in the best possible way if you work for OpenTable, but, OpenTable needs a data checker for sure, because I think half the time they release the data, I think, yesterday morning it said that we were up 40% for the year. And then, 3 hours later, the data got fixed. But you can see here the U.S. is still down 75% when it comes to restaurants. All right, so we've been reopening here since about May 1, and you can see that California has been a little bit behind, and we've caught up, but we're still down about 75% on restaurant data. So this is number of flights. So this is from Flight Status 24, and again, you can see here that flights are improving over time here. The one thing I'll note here is this is not seasonally adjusted, so I assume flights kind of pick up in the summer, and so some of this might just be seasonality versus some of this is actually airline traffic improving. We have passengers going through TSA, so this is seasonally adjusted because this is comparing the same day of the calendar year, and you can see that we're up to about 83% down, and so you can see that things are slowly improving when it comes to passenger traffic. No movie theater, to my knowledge, is really reopened yet, and so you can see this thing is still flatline down at 0. I think here in California, we're talking about some movie theaters possibly opening soon, so that will be interesting to see how many people actually go to the movies. And then one thing I just want to note here before I kind of give you the summary table is there's actually what I'm going to call dailyality. So we have something called seasonality, right? So people drive more miles in the summer than they drive in the winter. And so you have what's called seasonality, right? And it appears that on our data, we have some kind of dailyality. And you can see this very clearly when you look at the data. It kind of oscillates if you look at the trend, and you can see here that data is worse over the weekend, beginning of the week, and better at the end of the week. And you can also see this in number of COVID cases that we have in the data. You can see there's also dailyality there, right? So if you see a really low number on Sunday and Monday, that's maybe dailyality versus a trend in what you're seeing. So that's just something to note when it comes to dailyality in restaurants and air traffic. If we look at power consumption, so one thing you can always look at is power consumption. You can see we're just about flat. Again, I don't think a lot of people have used power consumption, so I'm not sure what the takeaway here is. It could be just it's really hot. Of course, it's pretty hot here in OC today, so maybe air conditioning consumption is higher than usual or something. But again, something to watch because it was down quite a bit. And so if we summarize all these things and we look at what's going on with Q2 so far, things are improving, but you can see still things are much worse in Q2 than Q1. And that's why we're expecting a really big drop in Q2 GDP as compared to Q1, right? So who do we really need to help forecast these things? All right, so who do we really need help from? And so really we need this guy. We need Marty and his time machine to tell us what's really going to happen, because there's a lot of uncertainty when it comes to what's going to happen with the economy, because we just don't know how things are going to go, right? So the first question we have to ask ourselves is, how scared are people, right? How scared are people to go outside in the economy, right? Because even if we reopen things, if people are scared, then we're not going to kind of have that demand. And so there's this interesting data on 538.com. Nate Silver does some good work here. And so they do polling data where they look at how worried people are about COVID. So they do surveys where they ask people, how worried are you about COVID? And you can see it over time here. And so back in March, kind of when things started shutting down, you could see there's a 64% difference between very and somewhat worried versus not very or not worried at all. You can see even at the end of May, that difference is still 66%. In the last week or so, it's actually dropped considerably. So it's down to about half of what it was. And some of that, unfortunately, is probably due to the change in the news cycle. It could just not be as prevalent to people in the news cycle because of unfortunate events. And so I'm not sure if that's what's driving the polling difference, but you can see polling here has definitely improved for COVID in the last week or so. How much of what we see now is pent up demand versus permanent? Of course, everyone's excited to go outside, and so it could be Tigger here where they're just jumping up and down to go outside and go to their favorite restaurant. I know, I've been craving some ramen, so maybe I'll get out and get some of that soon. And that's something to watch. Will there be more stimulus? I mean, this is really the question, right? I mean, people are saying, oh, I need $1 trillion. Well, no, maybe we should ask for $2 trillion. And, if we're really going to go for it, right? I mean, why do we ask for something good here? Let's go for a cool $3 trillion. And is that too much? Probably not, right? So the Democrats are talking about $3 trillion of stimulus coming up, and we'll see what happens there. And the question is, the stimulus is very important. So this is a graph that compares real personal income growth with and without transfer payments. So transfer payments are things like that $1,200 check people got in unemployment. And you can see here back in the last Great Recession, there's about a 5% difference between transfer payment income growth and non-transfer payment, because of course we had a stimulus in the last recession. And just to put that in perspective, we have a 17% difference last month, right? So we'd be down about 6% income without the help from the federal government, but we're actually up 11%. And of course, if we get a lot of stimulus and even more stimulus than we would have had income without the recession, then of course we're going to be better off if we continue to reopen. And then the last thing, and I know Bill's going to talk a little bit about this, is will there be a second wave, right? So Bill sent me this article, and so thank you to Bill sending this to me about Arizona's largest healthcare system is getting close to capacity. If you look at Arizona data, you can see cases and hospitalizations now are all-time high for Arizona. They were one of the first states to reopen, and just Texas yesterday, they actually hit an all-time high for hospitalizations. And so even if we're not talking about a lot of big numbers here, you can see the hospital systems are under some strain. All right. So of course that, what's going to happen in the economy depends a lot on what's going to happen with case data going forward. And of course, the other question is, what does all this mean for real estate and financial assets? And for that, I'm going to go ahead and turn things over here to Bill. So Bill's going to talk a bit about commercial and residential real estate. And of course, like I said, Bill runs the calculatorriskblog.com. And so Bill, why don't you go ahead and take it away?
Thanks, Chris. And I want to thank Steve and the Chambers for sponsoring this too. The first graph I want to put up is another employment graph. I don't see it. So am I going to be able to see the graphs Chris?
Oh, sure. You want me to share it for you, Bill?
Yeah, I'm sorry, I don't have it. Can you do
Oh,
it?
sure. Yeah. Just give me 1 second here. We're obviously not radio hosts here because we're not doing a good job filling the dead space here. But let me go
You've been
ahead
doing a great job doing it.
yeah, filling
So,
dead space. Yeah, there you go. All right. So just, I think you can see it now. So just tell me when you want me to go ahead and.
yeah, you can go on to the second slide.
Yep.
Okay, this is a different employment graph than the one that Chris showed. On this particular graph, this is the percent of jobs lost for every recession since World War II. And so you can see the blue line was the Great Recession back in 2007 through 2009, and we can see the sudden stop in 2020. I want to make a couple comments about this. This is not the unemployment rate. This is percent jobs lost. This graph understates the amount of employment damage that was done during this sudden stop. And that's one is because, as Chris mentioned, the PPP is also helping boost employment. And during the Great Recession, probably about 15% of households took an income hit. And right now, according to a weekly census survey, very close to 50% of households are taking an income hit. Not 100%, but so this really actually understates the damage. And what the key will be here is how quickly we can get back to the 0% line. It took a long time after the Great Recession. So we can go on to the next graph, Chris. The next graph shows new home sales. Now, new home sales are only, and this was in April, and it's only off about 10 or 15%. And this is an area that's held up better than most. And since new home sales are reported when contracts are signed, this might be the worst for new home sales in this cycle, maybe in May. We'll see when the May numbers come out. For existing home sales, which is the next graph, the sales are actually off more. They're off about 20%. And May is going to be much worse. And this is because existing home sales are reported when escrows actually closed. So, and as we know, there were very little action in April and May. So May sales are going to be really bad. June sales will probably still be bad. But the good news is that the next graph shows mortgage purchase applications. And you can see they've bounced back. So there's some hope that by July, the closed sales will be back up close to where they were at the beginning of the year. And so like I'm saying, in general, residential real estate hasn't taken a big hit yet. And that's going to really be dependent on how long the pandemic lasts. Right now, everything is going to bounce back and be pretty okay. The next graph shows one area of potential stress. This is a forbearance. The yellow line is the total forbearance. And these are mortgages that people have called up their lender and they've agreed to work out a different payment schedule. Some of these people are paying nothing until they can get their jobs back, and then they'll pay either more or extend the loan or whatever the agreement is. So these, and one of the interesting things is in April, about 50% of the people that were in forbearance still paid their mortgage. But in May, it's closer to 20%. So we're gonna see more delinquencies, but that doesn't necessarily mean more stress if these people can get back to their jobs. If they can't get back to their jobs, though, in general, the lending's been okay. People have equity in their house, so it's not gonna be a disaster, but there could be some stress in the housing market if this lingers. So the next graph, this does show the delinquency rate, and delinquency in April was 6.45, up sharply from March at 3.39%. And this does include loans in forbearance. So that once again, those are loans that hopefully won't go on to really being distressed sales. The people will work it out, and when they get their jobs back and can make their payments, they'll be fine. This is going to, since fewer people are paying their mortgages that are in forbearance, this is going to take another big jump in May, probably to 8 or 9% or something like that. But we shouldn't be too worried about that. The next graph is one of the reasons that there's very little home inventory out there, existing home inventory. As a matter of fact, this is for April. This is the all-time low for April, number of homes on the market. You know, it kind of makes sense. People don't want people walking through their house that they don't know. So, and maybe that's why new home sales have held up better, because, you know, new home builders don't really care about people walking through their homes. So, and then let's see here. And so that has fed through to house prices, and we haven't seen a decline in house prices yet. And I actually don't anticipate, with low inventory and demand picking back up, I don't anticipate house prices falling year over year. I know some people were forecasting that later this year. Once again, it really depends on how long the pandemic goes on. But for the next 6 months or something, we're still going to see year over year increases in house prices, I believe. So, and then I'm going to switch over to a little commercial real estate. So the graph that's up here is the hotel occupancy. And the black line, the blue line has been the median occupancy by week of the year. So, you know, the peak is always in the summer. There's a spring and fall business travel season. The black line was what happened in 2009, and that was horrible for hotels. So that was this record low occupancy for the data series, and probably the lowest since the Great Depression. And we see what happened in 2020 with the red line. Hotel occupancy is working its way back up. It's still far, far, far below 2009. So this means, you know, other than some of the financial help that they're getting with the disaster relief, hotels are really in struggling right now. And then the next graph is the Architectural Billings Index. And this is really mostly for commercial real estate, and it shows how much architects, really how busy they are. And basically, their business has gone as all-time record low. This will impact commercial construction in probably 9 months to a year, unless this bounces back very quickly, which I don't expect. I mean, who's going to go out with you know, the hotel occupancy really low and office occupancy really low? People aren't going to go out and start new projects. So the architects' phones are going to be pretty quiet. And the next slide is just a couple of articles that I wanted to point out. In the Washington Post, they pointed out that nearly half of the commercial retail rents were not paid in April and May. And that's going to put pressure on landlords. And the second article shows the delinquency rate on the commercial mortgages tripled. So, which is exactly what we expect. Now I want to make a comment on residential here. For renters, it really probably surprised some people, but renters are basically paying at the same rate they were last year. So people are still paying their rents, as opposed to the commercial where the rents, a lot of people aren't. And the reason that people are still paying their rents is because of the disaster relief. That's where people that are unemployed are getting they're getting unemployment benefits plus the extra $600 a week. And that's allowed them to keep paying their rents. When that ends at the end of July, if that's not extended or modified in some way, I expect to see the percentage of people paying their rents drop dramatically. And that can turn into a real issue. Right now, really the point of disaster relief is to support the economy while we're going through the pandemic. But if we don't have enough disaster relief and we you know, we're having a major economic problem, if we're not paying our rents like what's happening in the commercial section, then we put a financial crisis on top of an economic crisis, on top of a pandemic health crisis. And that's definitely something we don't want to do. So I do expect to see further disaster relief announced sometime in July. So now I'm going to switch gears here and say something. The virus is really going to drive what's going to happen in the economy. So when we're making predictions about what's going to happen, we have to kind of say what we think is going to happen with the pandemic. This first slide I have just kind of shows, you know, the solutions to the pandemic, well, we're all hoping for the pharmaceutical solution, a vaccine, or a very effective treatment. And we all know about the non-pharmaceutical interventions, social distancing, wearing masks, et cetera. I'm going to talk a little bit about test, trace, isolate, and support. But I want to mention something. In the US, we've had a real problem with messaging. We've told people that we want to bend the curve and save the healthcare workers, which is completely true. But if you go over to the European countries, they pitched it very differently. They said we want to bend the curve and we want to suppress the infection rate. And so if you go over and look at how Italy and Spain, who've had horrible problems, Germany, they've really driven down the infection rate before they started to open the economy. What we've done is we've bent the curve to help our healthcare crisis, although we have this problem in Arizona that Chris was mentioning. So we're going to try to start opening without really driving down significantly the infection rate. We've got it down in New York and New Jersey significantly, but there are other areas of the country that we haven't done as well as we could. And when I'm talking about messaging problems, we've also had this really kind of a terrible messaging problem with masks. You should wear them, you shouldn't wear them. The answer is basically every country that's doing well requires masks. And if you go, so this is really one of the major differences between the US and the other countries that are making some success. Let's go on to the next slide, Chris. This slide shows the number of tests per day in the US and the percent positive. So the red's percent positive. Now, if we go back to the beginning of March, where we had essentially 0 tests per day, South Korea was doing 20,000 tests per day. And they had a robust test and trace program where if anybody tested positive, they would test every single person around that they've come in contact with the last 10 days to 2 weeks. The US, to be equivalent to that, would be, we're about 6 times the population. So maybe we got there in early April, but by that time we had a lot more infections than South Korea. So we're way behind the ball. And even today, the countries that have been successful have gotten the percent positive down to 2-3%, even lower. Even today, we're just under 5% positive. We might have to actually double from the 400,000, 500,000 tests we're doing today to get to 800,000 to 1 million tests to really successfully do test and trace. And one of the things about test and trace, and I'd like to mention the site testandtrace.com that the CDC recommends people go to. It's a great site that keeps track of how many tests are being done in each state, how many contact tracers each state has hired. They have resources for what each state should do to do test and trace, because we really don't have a federal program. We have to do it, we're doing it state by state, so it's a great resource for each of the states. This is going to be one of the keys to moving forward and opening safely is getting test and trace. When somebody tests positive, we traced all their contacts. It's actually usually called test, trace, isolate, and support. Then we ask the person to isolate, we check back on them and support them as much as they need until they test negative. So this is going to be a key going forward to open successfully. And let's go to the next slide. This is the unfortunate Orange County situation. The blue line is the number of people hospitalized. That orange line is the ICUs. The trend is not our friend in Orange County. And so we're opening and we're opening safely. And so we need to take some, now let me just stop. Arizona, that large healthcare is up to about, they're almost out of ICU beds. In Orange County, we're probably around 15% are occupied with COVID. So, if it doubles again in the next month, we're up to 30%. But we need to really address that as we open. And so it's important that we keep this in mind. I think one of the big things that we want to do is as we reopen safely is we want to do some messaging. We want to tell people that the pandemic is still here. I feel like when I go out of my house that a lot of people think it's over. It's not. Look at these numbers from Orange County. we need to message that it's getting worse in Orange County. Not horrible, but it's steadily getting worse. We need to follow all the health code rules. The health department's put out a great set of rules on how to safely open. I'm not sure people are paying attention. Like the Orange County Department of Health says masks are required. If you go into a retail store, I see people walking into retail stores without masks. Masks are required if you're outside, if you come within 6 feet of somebody. I see people all the time passing within 6 feet. Now, it's a low risk thing, I know, but we don't do it. And we also really don't do any enforcement. So there's my little talk on the virus. The outlook is really dependent on the course of the pandemic. So to open safely, to get the economy really humming again, we've got to really pay attention to the pandemic. Now, I think residential real estate, new construction was considered an essential service during the shutdown, so it continued. Home sales should pick up back in the reports in the next month or two. Everything in the residential area should be fine unless the pandemic just keeps on going. And then we could still really have some serious problems. Commercial real estate, I'm a little more concerned about. We have those unpaid rents, the vacancies, the mortgage defaults. So, and towards the end of the year, unless people start planning, we're going to have very little new CRE construction, and that can impact the economy overall. So this could become severe. So at this point, I'll turn it back to Chris. Sorry I wasn't all the sunshine that I usually am, Chris.
That's all right, Bill. I don't think anyone's been saying that I'm a lot of sunshine these days either. So we're even. How's that sound? All right, everybody. I'm going to talk about financial markets here for about 5 or 8 minutes. And so this would be a great time if you happen to put some questions in. We're definitely going to do some questions here when I'm done. So, current thoughts of the stock market. I'm telling you, I've had more people ask me to try and explain the stock market to them in the last few weeks. And this is kind of my thought process on the stock market. I mean, that's all I really have to say. I don't understand what to tell people. And I mean, I don't really think there's anything that can describe what's going on with the stock market more really than Hertz rental car. So this is Hertz stock chart, if you believe it or not. So this is their stock return as of starting with May 1st, right? So of course, Hertz declares bankruptcy they declare bankruptcy there on May 22nd when the market closed. So that May 26th open is after they declare bankruptcy or down 50 cent stock or something like that. And then of course, over the last few days, this thing's up 1,100% in the last few days. And I mean, I don't really know what to tell anybody because of course, if you look at this, if I look at a 2024 unsecured bond, which by the way gets all of their money paid back before stockholders see 1 cent, it's trading at 40% of par. So in other words, someone who owns this bond that gets paid before the stock gets paid is expecting only to make 40 cents on the dollar, and yet the stock is worth like $5. I think it's down now last time I looked. But really, when you see something like this and you just ask yourself, I mean, wait, what? I mean, how does this work? I mean, we're back right where we were with the unemployment report. But the good news is I have a scientific explanation for this one. And that's, of course, the Robin Hooders. All right. So we got the Robin Hooders who have an English accent. And so maybe that's why, because they understand more than we do. But really, I think this is the classic retail investor right here. So the black line here is the number of Robinhood accounts that own Hertz. And so you can see here starting on March, they started buying Hertz the whole way down. So I believe that's what we call in finance dumb money. And then, of course, once they declare bankruptcy, apparently the appeal of the stock went way up once everyone, the company publicly said it was worth nothing. And you can see the number of accounts has exploded. And you see the same thing with Chesapeake Energy and a bunch of other bankrupt companies. So please, unless you're gambling, do not buy these stocks. These things are worthless. They're going to get delisted at some point soon, and you're going to end up with $0. So that's my little Susie Orman moment for this particular talk. All right, so what's going on with the market? So, year over year, S&P's up 12%. Now we're actually flat. I think we might be down a little bit based on today, but we're flat year to date, which is pretty unbelievable. If I told you we would have lost 20 million jobs and GDP would drop 40% in Q2 and earnings would be down so much that, 20% this year, and I told you the market was flat, you'd tell me I'm crazy. Well, clearly I'm crazy because the market's flat. The only good things I can really say about the market is, one, earnings are stabilizing here. So forecasts have stopped dropping. So we're only, in quotes here, expecting a 20% drop for this year. And you can see next year, we're expecting a magnificent growth of 28% next year in earnings growth, which, by the way, will still leave us about where we were for 2019, right? So basically, at the end of next year, we're going to be at 2019 earnings. And so you don't have to be a mathematician to figure out that, well, if stocks are near where they were before and earnings are down 20%, that, PEs must be high, and they are, they're about as high as this guy. That's all I have to say about that. I mean, this is forward PE, right? So this is forward price to earnings ratio. So this is how expensive stocks are. This is essentially as expensive as stocks were in 1999 if you were trying to buy them, which, for a while good and then didn't turn out that well. I actually saw a tweet yesterday that the S&P is 9% over end of year analyst forecast, which is the highest since 1999, which is maybe not another good indicator. If we look at backward looking PE, so this is earnings that already happened, we're at a PE of 31. So you can see here, again, only Great Depression and the internet bubble where it was PE higher than what it is today. And just to remind you, that's probably not a good thing. So why are things so cheap? All right. So, why are PE so high? So the first thing is interest rates are so low, right? So, if you think about it, your choice is buying bonds or stocks. Well, you can buy a 10-year bond, which is earning you about 0.8, 0.9% right now, which doesn't sound very appealing. The 6-month T-bill is earning 0%. And so people, I think, are attracted to stocks because yields are so low. The one thing I'll note here on the chart is you can see yields have started to go up here. So we were about 6.6, 0.5% a few weeks ago, or 0.9%. And so this is going to be an interesting thing to watch. And I'll bring this up in my conclusion here in just a minute that I'm going to keep watching. So interest rates are low, which means that essentially dividends, if you compare them to interest rates, look really good. So the dividend yield in the S&P is still about 2% versus 0.8, 0.9% on the 10-year. And so again, this is that inversion where the dividend yield is greater than the 10-year treasury. That doesn't happen very often. And so again, if your choice is to buy, Pepsi or some other companies that are giving you a 2.5%, 3% dividend, and your other choice is to buy some 0.7% bonds, that's one thing that does make stocks a bit more appealing. All right. Why else are stocks? So there's a lot of money out there. All right. So the Fed's upped the balance sheet about $3 trillion here over the last few weeks as it tries to support the economy. Buying all sorts of bonds. I probably could have a picture of the kitchen sink here, but I didn't put one in there. So they've been buying a bunch of stuff. But it doesn't matter how you look at it, all the buying, everything else, once you push up stock prices, your future return is lower, right? So the higher you buy something for today, the less that you're going to make on it in the future. And so a PE back at 31, we're basically right where we were in January when I did the Greater Irvine Chamber, where, based on the cap PE, we're looking at a 4%, per year stock return over the next 10 years. Which clearly is not a very good stock return compared to historical standards, right? So we're looking at a pretty low return. If we look at bond spreads here, so this is a BBB, so you can think about this as like a 720 credit score. So that's what a BBB corporate bond would stand for. If you look at junk bonds, so you can think of like this as like a 600 credit score. That's the blue line. You can see the extra amount of interest these companies have had to pay has been pulling down here over the last few weeks. And really, if you look at BBBs, they're almost back where they were before the crisis, and you can see the same thing here with high yield. So a lot of the risk premium that you were getting from these bonds in the crisis has already been pulled out by investors, right? So a couple of things to know here. I know a lot of people worry about inflation, all right? And so I think it's really important to talk about this because I have a little bit of concern about some demand supply issues and inflation. But if you think it's because of the Fed, I don't think that's going to be the thing that drives it here. So this is a comparison of how much the Fed has grown its balance sheet. And the blue line here is comparing the financial crisis to now. And you can see, for the COVID crisis, the Fed is way behind where it was for the financial crisis, which, by the way, did not lead it to any inflation. So that's why I want to put it out there. So we're behind where we were before. And if you think about something like gold as an indicator of inflation, so this is gold that you have here. So this is a comparison of gold prices. So 28 gold is in silver or gray, and you can see how that moves along. And you can see gold for 2020 is in the same level here. So in terms of inflation, expectations, that way we look pretty good. If you look at inflation expectations for the market, we're only looking at about 1.3% right now over the next 10 years. So if you're worried about inflation, it's something the market's not particularly worried about in the moment. If you look at, implied inflation expectations or gold. And so that's not something I'm particularly worried about. Some people are worried about the dollar. So this is the dollar index against major countries. So higher here means stronger dollar. The dollar's flat for the year. Some people, I've read an article this morning that says the end of the dollar. And I have to kind of sort of laugh at that because every single other country is expanding their monetary balance sheet as much as we are, right? The ECB's buying stuff, Bank of Japan's buying stuff. And so really, if you think about the dollar versus the yen or the dollar versus the euro, if we're all printing a lot of money, then really it's the euro is no different than the dollar. And so I'm not expecting any huge revelations in the dollar index. All right, so just to conclude here, and again, if you want to ask a question, it's a great time to put your question in. The economy is slowly recovering, so you can see the data there where it's slowly going up there. What kind of speed or shape we have depends on a lot of things. I think it doesn't matter what you think, though. Employment and things like that are going to take a very, very long time to recover. I think the easy bond and stock returns are over. I think the market, if you look at the data here, essentially has just overrun where we were with COVID. And really has put us in a position where stocks are pretty darn expensive right now. And so, I think back in March, I told you after the market was down 40% to make sure you rebalance your portfolio. And so if you did that, you're way overweight in stocks right now. This is probably a good time to go back and rebalance your portfolio again, just to make sure if you're 60-40, you're back to 60-40 again. It's a great time to sell some stocks at a high price, especially if you rebalance when they were low. And I really and this is my last point, something we're gonna have to watch. I really kind of feel like we're between a rock and a hard place, right? There's always this place in the economic cycle where the Fed's in a pickle, right? Where if the economy has this V-shaped recovery that people want, then that means they're gonna have to pull the plug on their support, which isn't gonna be good for the markets. And if the economy craters from here with the market expecting such a big recovery, and the Fed has to support more, that's also bad for the market, right? So there's at some point soon we're gonna come to where good news is bad news because the Fed's gonna go ahead and pull the plug, and bad news is bad news because that means the economy is not doing well. And I feel like we're probably getting pretty close to that place. So again, I want to thank the Chambers for having us here. I want to thank Bill for joining us. It's always great to have Bill on the blog here and help us out here. And of course, if you want to give a little bit of CIWM, I have your link on the bottom. And with that, Steve, if you want to go ahead and start doling out questions, be happy to answer them.
That's great. Thank you, Chris. And thank you, Bill, for your concise reports. So we do have a number of questions here, so I'll try and sift through them as best as I can. First question looks like it's going to be for Chris. How could our economy bounce back so quickly with very high unemployment numbers that are questionable?
So I'm not sure 100% what you mean by the questionable. So, I'll say that the unemployment so I think you have to be a little bit careful saying that the numbers are questionable, right? So you have to remember this thing moves so fast. It's very hard to make statistical adjustments when you have something. I mean, you saw that first graph I showed you where the change in employment every month is an order of magnitude greater than it's ever been before, right? So as a statistician, I can completely understand why the numbers might not be 100% perfect. In terms of why things can improve so fast, I mean, it's kind of like, think about like a store that's been closed overnight, right? So if you look at the number of customers during the store overnight or number of employees, it's zero, right? And then the next morning, even though not many people go to the grocery store at 6 a.m., it's still got a lot more employees than it did at 3 in the morning, and it's still got a lot more customers. And so right now it's kind of like 6 a.m. at the grocery store where we've reopened, and so we're gonna have a big improvement just because of how big we dropped. And so that's why the numbers are, like I said, we have a record number of jobs that we created last month, but it's all relative to the incredible record number of jobs we destroyed the previous month.
Very true. Next question. Do the policies of Germany regarding partial employment work better than PPP?
Bill, you want to handle that one?
Well, I think they work better in the sense that they're automatic. In the US, we had to scramble to pass plans. Otherwise, between the PPP and the extra benefits for the unemployment, I think we have something similar to Germany. The difference is that ours doesn't show up ours shows up in the unemployment rate. All those people that got laid off and are getting the extra unemployment. Theirs does not. Theirs is more like PPP completely across the board. So I think their main advantages is pretty much automatic.
Very good. Next question looks like it's addressed to Bill as well. It took a lot of time to recover from the Great Recession damage, almost 10 years, at least according to this question. How much time will it take, in your opinion, this time?
Well, first of all, I don't think it really took 10 years to recover, but this time it really depends on how long the pandemic lasts. unemployment, the labor market's going to be hurt for a long time. It's going to take, there's going to be adjustments coming. I mean, even if we've got a vaccine at the end of the year, I would say it's going to probably take at least a few years. And Chris can probably throw his 2 cents on that one too.
I think if you look at economic recoveries, there's always a particular order things follow, right? And I think Bill would probably agree with the data, which is the stock market, generally speaking, is probably one of the first things to recover, right? Because it's forward looking. GDP is, usually either around the same time of the stock market or next, and then employment's always the last thing to come back. And so, if you look at the Great Recession, it took, however many years it took for employment to come back, but it only took, 3 years or less for GDP to come back. And the stock market was particularly hit, but it still came back before employment. So, I think generally employment is kind of the biggest lagging indicator because, people find a way to be more productive. So I think a lot of the jobs that were lost will probably never come back again. And so those jobs will be transformed into something else. But I think employment will be the last thing that we'll see recover.
Very good. Next question is probably for Chris. With business sectors like restaurants, gyms, movie theaters, et cetera, potentially operating at 25 to 40% of capacity, and it's still having many similar operating costs, do you foresee similar offsetting price increases to cover the gap for general consumers? Is that $20 steak now going to be $40, and is a movie ticket now going to be $30? I don't know where Jeff's going for steaks, but $20 steak would be pretty good.
Yeah. So the Mastro steak would be 400 based on Jeff math, I think. But,
exactly.
So I think that's that you're between a rock and a hard place, right? Because if you double your prices, then you lose customers, and maybe that's what people can do because they you only have 25% capacity, so I need 25% of your customers, right? So, I do, that's kind of the inflation that I do worry about is I do worry about, if you're a restaurant with 50% demand and 80% of your customers show up, then of course you can raise your prices on things, and that's going to affect the 80% of people that can eat there. I think more generally speaking, I think my concern is that, no company can really make money on 40% capacity. Right. And so you have all these small businesses that are going to be at 40% capacity for 8-9 months. And as Bill mentioned, if there's no more relief, I mean, how many small businesses are left? And I didn't have time to put it up there, but one of the most interesting things to me about this is, is the stock market up? Because essentially this recession has been a huge favor to big business, right? They essentially, all the rules have favored big business over small business. If you really look at the bailout amounts, at the stores that were allowed to be open because they're deemed essential. And so this is the first time actually, if you look the last 2 recessions, small caps outperform mid caps, would outperform large caps. But in this particular recession, it's large caps that have outperformed mid caps that have outperformed small caps. And probably if you had a small business index, it's even worse, right? So if all the coffee shops, the mom and pop coffee shops open are closed permanently because they don't have money, who's that benefit? Well, that benefits Starbucks, right? Because they're the ones that have the money to withstand things. So I think that's my bigger concern is how many companies can last at 40% revenue for 8 months.
Very good. Next question is for Bill. Bill, what about the industrial and warehousing sectors? Any data you can share that you have?
I don't have any specific data for either of those sectors. So, but I would say that the drop in architectural billing index does include those sectors. So they're probably not planning on building any new ones in the near future. But I don't know how they're performing.
Okay. Any prediction on how payment delays are going to affect credit? I'll probably throw that to Chris.
I think Bill could probably answer that. I mean, I think for a while here, I mean, I think there's probably some rules in place where, probably you're not allowed to ding people's credit scores or people will be a little bit more flexible. But I'm sure at some point, there's probably a lot of people who, once the rules change and that they're allowed to foreclose or they're allowed to, kick out tenants, I think that's probably when you'll start to see the reports. I think here in California, it's end of June or end of July, the grace period on rent ends. So that'll be interesting to watch. Bill might want to have some thoughts on that too.
Yeah, I think loans in forbearance are not included as delinquent on your credit reports. And the fact that almost the same amount of people are paying their rent this year as last year says that we don't really have a lot of people going to take a big hit. I'm sure there's people that aren't paying, and there's going to be some evictions coming up on their rents. But in general, I don't think it's going to hit the credit reports yet. And if we get some more disaster relief, I think the renters will be fine. The forbearance programs don't count on the credit. So in general, I think that we should be okay. It won't be a big hit to the credit reports.
Oh, Steve, you're muted.
Did you want to take a stab at what interest rates are going to be for the rest of the year?
Low.
I'll leave that to Chris.
I mean, you know, the Fed's in control, right? I mean, ultimately, you know, I think you'll probably see the 10-year bounce up a little bit. I don't think it's going to stay at 0.7, 0.8, especially, you know, again, like I said, given supply. You know, this one's probably right there with the stock market or the economy or anything else, right? It really depends on what happens, right? So if we reclose again and we have to do more programs and the Fed has to really get aggressive, then we're going to have rates at zero. I mean, there's someone from the St. Louis Fed that's said we might need negative rates to get through this. And so I think it's hard. So I think I will say lower than 2019, I think is a safe answer. But whether or not they stay this low or not, I think it really depends on the economy.
Well, one interesting thing is tomorrow we're going to get an FOMC announcement. I don't expect any change to policy, but we're expecting projections from the FOMC. I believe the FOMC is quite a bit more bearish than, say, the fiscal policymakers.
Yes.
And we'll see that tomorrow, and that's really what's going to drive interest rates.
Yep.
Very good. With the trend of retail stores closing and moving online, more people working from home, and possibly even after the pandemic, how do you predict the effect will be on the future of commercial real estate?
Well,
sounds like a Bill question.
Yeah. Well, you know, people have been saying that it's the end of the office building for as long as I think 20 years or more, and people are still building new offices. So you know, it could work the other way. People may need more space because people don't want to be as packed together in an office space. For commercial, you know, hotels are going to come back eventually. It's just a matter of time. The other sectors like warehouse and industrial, they should be all go back to where they were. I'm not negative on well, let's get to retail. Retail has been struggling for a while because of Amazon and other online selling. So brick and mortar retail is an issue, and this probably makes that even a little bit worse going forward.
Okay, next question. In May, we saw some chatter about market pricing and negative interest rates in the US by June 2021. Any thoughts on the probability of negative interest rates here in the US and what the impact would be to the markets?
I guess I'll go on this one first, and Bill can chime in if you. I mean, there's a non-zero probability. I mean, when people were saying the market was pricing in negative interest rates, please note that they were pricing in like a negative interest rate of like negative 0.2%. So it wasn't like the Germans where it was like minus 0.5% or something like that. It was, you know, it was probably just some noise in the data. I mean, I haven't heard any serious discussion from the Fed of going negative rates. You know, right now they don't really need to, right? So as long as inflation's higher than zero, you really don't need negative rates. So the whole point of really low interest rates is to encourage people to take their money out of the checking account and invest it, right? Because if you leave it in the checking account, you lose purchasing power. And so as long as they can drive, you know, real yields negative, which they can still do, and with oil bouncing back, I mean, a lot of the data we have is oil was driving the regular CPI down. You know, with oil bouncing back and whatnot, I'd have to imagine that right now, at least in my view, they don't need to go negative. And I certainly don't think the Fed's going to go negative unless they really have to, because that's when you start having some kind of weird financial conditions. So my guess is we won't go negative, but you know, it's possible.
Okay. Assuming you're not investing in equities, what types of alternative investments might you explore today?
Definitely not Hertz stock. I mean, that's one place I would probably invest today. Look, it's financial markets are incredibly efficient, right? It's hard to beat the market. If you want to get a higher return, you have to take on more risk. I mean, that's just how things work in the long term. And if you're an incredibly good investor, then you start a hedge fund, right? I mean, that's the way things work. And right now for me, when I look at the market, I mean, the places that I'm more interested in, given how high prices are, I mean, I'm more on the high dividend, the consumer staples, or like a LQD, like 3% on corporates. I think that's a better deal than what you get on treasuries. But if you, in terms of alternatives, I mean, I wouldn't buy Bitcoin. You have no idea what Bitcoin's priced as, and I wouldn't buy Beanie Babies or baseball cards or whatever. So it's really hard to say, in conventional terms, what to buy. I think we just have to come up with the reality that future returns are going to be low. And unless you want to do something crazy, you're going to have to just be prepared for low future returns. That's kind of what I think. So the only exception to that would
question here for Bill. Any concerns about?
Sorry. No, that's all right. Go ahead. A little video. Why don't we do 2 more questions, Steve? They're just at 12:32. Don't want to hold people.
Yeah, very good. Question for Bill. Any concerns about population growth due to the immigration cuts, et cetera, for long-term outlook of the economy?
Yes. This is something that I've written about quite a bit on the blog. I used to write posts that said, "The future's so bright, I have to wear shades." Part of that was based on demographics. Right now, we have the largest cohort is in the late 20s, early to mid 30s group. And that's a really powerful time for people to create families, buy houses. And I've always been looking forward to this decade. I thought it was going to be the best decade in a long time. And when I was saying the 20s are going to be, this is going to be the roaring 20s again 10 years ago, people thought I was crazy, but I really thought so. But we've had some real negative data come out. The census projections from 10 years ago are not what's happened. There's been a lot less immigration, especially in the prime working age, and we've had more deaths in the prime working age, primarily before COVID from the opioid issues. But so it's still good demographics for new family formation, for babies, for houses, but it's not anywhere near as good as it was 5 to 8 years, or it looked like it was going to be 5 to 8 years ago.
I mean, I think just a quick comment, I think if you look at the projections for next 20, 30, 40 years, I mean, the working age population growth, if you just think from, kind of 22 to 65, I mean, it's pretty close to zero. And so, it's hard to grow an economy when you have 0% new workers. I mean, I always tell people, just imagine you have a business and you can hire no one. How much are you really able to grow your business if you can't hire anyone? So I think demographics are a huge driver of what's going on with our economy for the long term. And I mean, you can, I have this chart where you do a correlation between working age population growth and GDP growth, and they're right on top of each other, right? So, I mean, look at Japan, right? The reason Japan can never grow is because they have less people every year. It's hard to grow your economy that way. Maybe one more question, Steve? Or did we lose Steve? I think we might have lost Steve. I only see Bill and I here. Anyway,
well, thanks for having me, Chris. It was a real pleasure being here. Sorry I had such negative comments.
So it's okay. I mean, I appreciate everyone tuning in today, and I hope you enjoyed and learned some. Oh, Steve's back. So Steve, we're just wrapping up here. We saw you drop, and we want to thank everyone for coming.
Yes, sorry. That's a little bit of a connection problem there, but
so thank you everyone for coming. We look forward to seeing you on the next webinar. Thanks again, Bill, and all the chambers for partnering, and we'll talk to you soon.
Thank you.
Thanks.